Yeah, hello everybody, and welcome to our webinar on direct lending today. My name is Michel Degoschu, and I would like to talk over the next around 30 minutes about an asset class that we are covering, where we do research on, and where we also have indices measuring the risk and performance characteristics of this asset class. And I would like to guide you through and question how can direct lending be accessed via various investment possibilities, how we construct the indices, and how the market has changed over the past 10 to 20 years. We started analyzing direct lending companies a couple of years ago. But when you go back to 2008, 2009, there were not that many companies that were listed on a stock exchange where we could do research on. So only over the past years, listed private credit or listed direct lending companies emerged so that we are able to construct indices, to construct benchmarks on that asset class. When you look at the alternative investment space, we typically look at three asset classes. We look at private equity, we look at infrastructure, and now we look also on direct lending. Private equity is something we started from the beginning when we launched LPX in 2004. We launched the very first private equity indices measuring the risk and return characteristics of publicly traded private equity companies. One of the indices that we constructed is the LPX 50 index, which measures the performance and risk return characteristics of the 50 largest private equity stocks. In 2007, we started to analyze infrastructure companies, so companies that provide infrastructure facilities like toll roads, shipping ports, airports, and so on. So that are companies that also are listed on the stock exchange but are operating infrastructure facilities. Direct lending, the topic we are talking about today, is something where institutional investors but also private equity investors can have access to via various investment funds. But in the meantime, there are also listed direct lending companies that provide private credit, private debt to unquoted companies, but are themselves listed on the stock exchange. And this is something where we have the focus on. When you look how you can classify direct lending within the asset allocation, it sits between stocks and fixed income. As I mentioned, we focus on direct lending companies that are listed on the stock exchange but provide loans to unquoted companies and in return generate an interest rate. So it's on the one hand side, it has some fixed income characteristics, but on the other side, because the companies are listed on the stock exchange, it also has some characteristics from publicly traded stocks. And when we have a look at the direct lending market in total, it's a very interesting development that we have seen over the past 15 or 20 years. We have seen that, let's say in 2008, we had roughly 8,000 banks. And right now, this number has decreased to below 5,000 banks in the United States. On the other side, that's on the right-hand side of that slide. When you look at the companies that are non-banks, so companies that provide loans or credits to other unquoted companies, but are not classified and not regulated as a bank, that number has significantly increased over the past 30 years or so. And the market share has increased from 29% to over 90%. So over 90% of the credit market is now serviced by non-banks, which I think is a very interesting development. And the question is then, how can you as an investor access that type of risk and return possibilities that you usually don't have as long as you are not a bank? So this means also that the size, the size of the loans and the number of lenders and borrowers is steadily increasing, and this number shows you the total AUM managed in private debt or private credit over the past 15 years, and the assumed assets under management in 2025, so for next year, and that's close to 1.5 trillion. So it's a huge market that is emerging here. And we see more and more companies, and also we see more and more companies listed themselves at the stock exchange and provide loans and credits to other companies. But I come to that in a minute. Now, traditionally, how can you access the private credit market? On the one hand side, we have syndicated loans. That's something that is in the market for decades. So that's not something new, but typically this is only available for very large institutional investors. I'm not even talking about retail investors, but also medium-sized or small institutional investors. Was not easy to access that type of investment possibility. However, in the meantime, that's also getting easier, but still it's not something that you can easily include in an asset allocation in a way where you include bond investment or an equity and stock market investment. So that's still not that easy to implement in the asset allocation. In the meantime, there are also closed-end funds where you can commit capital to a fund that then provides credits or loans to other companies. There are also so-called platforms, B2B, also B2C platforms where it is possible to provide a loan directly to either private individuals or to companies, to medium-sized companies. And then the third route are listed companies that are listed on the stock exchange and provide loans to, in most of the cases, to other companies. And usually they don't provide loans to private individuals. It's usually to companies. That's the focus of LPX and what I wanted to talk about today. Just summarizing how those two investment possibilities look like. As mentioned, on the one hand side, you have an unlisted fund, typically structured as a limited partnership, where you have a general partner who is managing that type of partnership and is generating a fee income from that management. On the other side, you have a listed company which provides the loans from the balance sheet, so it's a direct exposure to other companies. And then you have the management team that is usually at the company level, where you simply have to provide and pay salaries to the managers. So that's summarizing those two main possibilities. Of course, there are other variants of that, other possibilities, but to summarize, this is the main two ways how you can access direct lending or private credit as an investor. There are some advantages of direct lending in general. So that's true not only for listed private credit, listed direct lending companies, but that's also true for the other For the other investment possibilities, on the one hand side, you have typically a protection against rising interest rates and the reason for this is because you typically don't have a duration in the investment loans in the investment portfolio, because typically you have a floating rate coupon, which is usually not fixed by definition. It's typically linked either to the LIBOR in the past or going forward to the so-called SOFR index, which is then included in the contracts. And what we currently see is that more and more companies replace the LIBOR index with a new index, which has now been accepted as a benchmark or standard in the industry. But the main point here is you don't have the risk of rising or changing interest rates. Basically, the loan portfolio and the interest rates change with the interest rate environment. You typically have also a higher security compared to a typical bond portfolio, which is unsecured. Typically in the loan, private credit, direct lending market, whatever you would like to call it, you see that the loans are secured and have a very high seniority. I come to the breakdown later how this looks like in a diversified portfolio. Typically, you have also higher safeguards and a higher control. And why is that? Because typically what you see is that in many cases, the loans are provided to medium-sized companies, which on the other hand, also in some cases get an equity financing, which can be which usually has the advantage that you have a higher control because you have someone else who has provided equity to that type of company and has much stricter rules and a much higher governance than when you compare this to a typical bond investment. And last but not least, you have a very high diversification. So with a very small amount of investment, you have a direct access to a diversified loan portfolio over thousands of investments in private credits. So, but as mentioned, this is true in general for the asset class of direct lending or private credit. And this is showing the interest rate environment over the past decades. Below you see the development of the LIBOR index, and on the right-hand side at the top of the slide, you see this secured overnight financing rate, which is replacing the LIBOR index. And as you can see, this is changing with the interest rate environment and basically makes sure that the loan investor or that provides the loans to the companies has no duration or almost no duration in the loan portfolio. And it also offers some very attractive yields. Here you see three indices, three benchmarks on the direct lending market. You see the Morningstar US Leveraged Loan Index, and this is compared to the Bloomberg US Corporate High Yield Index. And as you can see, the direct lending index, this is the index which is calculated and measured by LPX, has always been above those two other lines. So direct lending via listed companies also provides a slightly higher yield. And on the other side, when you then look at the investment company level, you'll also realize that almost 80% of the companies that are part of the index also have a investment grade rating. So despite the fact that they provide loans to medium-sized companies, the companies or the investment companies itself are rated and have a higher rating than high yield by definition, because they have an investment grade rating. But on the other side, you get a higher yield. So it's a kind of interesting risk return profile. You have some slightly lower risk, I would say, but on the other side, you have a slightly higher return. And there are various reasons that are responsible for that. I come to that in a minute, but just to summarize here, on the right-hand side, you see the actual yield. So as of December last year, the direct lending index had a yield end of December of around 10.3% in US dollar, compared to the Morningstar US leveraged loan of 9.4%, and the high yield index by Bloomberg has only 7.59%. So a significantly higher yield. And the question is now how or what exposure do you get when investing into that type of direct lending companies? As you can see here, we have around 40 companies, or to be precise, 42 companies currently in our universe. The total market cap of those companies is around 60 billion US dollar. So it's still a niche market. And as you can see, it has grown steadily over the past years. But in 2009, 2010, we only had roughly 10 billion. So a very small asset class. But again, it has grown significantly over the past years. Now it is possible also to launch and to construct an index that is measuring the performance of that asset class. To give you an example, here you see two companies, SLR Investment and Oaktree Investment. So what they basically do, they provide loans to companies, in this case, Alimera Science or Optio. And here you can see on the one hand side the principal, so the amount of the loan they provide, and then the interest rate. In this case, it's still the LIBOR. So the reason for this is usually when the contract or the loan has been granted before the discontinuation of the LIBOR, it's still referring in many contracts to the LIBOR. This is going to be replaced, but because it's maturing this year, I'm not assuming that they're going to replace the LIBOR in the contract. So that's why you still see LIBOR being mentioned in those contracts that have been signed before the discontinuation of the LIBOR. This doesn't change anything in the risk return structure. So over the past years, it was a very smooth transition to the new benchmark. But yeah, don't be confused why this is still being mentioned here. And as you can see, you have the LIBOR as a base, and then a fixed rate on top of that, making sure that the interest rates change with the interest rate environment. So now coming back to the index, and to give you some of the characteristics of the index. So we start with the global universe of stocks and then focus on those companies that provide private equity, infrastructure, or private credit to other companies. In this case, we are now focusing on those companies that provide private credit, provide debt capital. In total, we have more than 5,000 single loans in total in the investment portfolio. And then we have 42 companies that are part of that investment portfolio, and we focus here on the 25 largest and most liquid stocks of that universe, and then come up with the so-called DLX Direct Lending Index, which is a standard, or which is an index that is calculated like any other index. So we're rating according to market cap. We have a capping on each company. The index is calculated every day, so you have a daily time series available of that index, and so on. And then by calculating that index, we are able not only to calculate the yields in the underlying investment portfolio, but we are also able to calculate the risk and return characteristics overall of that market. And here you see the performance chart of that index going back to 2010. And here you can see the risk and return characteristics. Over that period, the return was around 10% on an annualized basis. So on average, you made roughly 10% of that. And here you see two lines. I think that's kind of interesting. You see the price index, which is measuring the stock price performance of those direct lending companies. And you see it's more or less stable. And on the other side, you see the total return index, which is reflecting the stock price and dividend payments, which returned that 10.36% on average over that time frame. So, but the main story here, the main message here is that return performance drivers were dividend payments over that time period. So you should not expect a price change because of the business model of the companies itself. You should only expect the return driven by dividend payments, and those dividend payments are driven by interest rate payments from those borrowers. So I think that's kind of interesting, and it shows that that despite the fact that the companies are listed on the stock exchange, you get the economic exposure of a loan portfolio here. And usually what we also see that those companies pay out the dividends to, or the pay out the earnings in via dividend payments to the investors. So from an economic perspective, it's very close to a loan portfolio. However, you have to be aware of the fact that the companies are still listed, so you will still see daily price changes of those companies. But when we look at the historical dividend yields, so going back to 2009, you see that it has always been a kind of a very attractive asset class, ranging from 7.24% up to 10.9% yield every year. And the yield here is calculated in a way that we, at the end of each year, we look at the composition in the index and then look at the expected dividend yield for the next year, which is then related to the stock price of those companies. So now let's have a look at the portfolio characteristics. As you can see here, most of the loans are provided in North America, so that's mainly US. Some loans in Canada, but mainly, to be honest, is United States. One of the largest companies here in that universe is Ares Capital. I've seen there was also a question regarding Ares. Yes, that's part of the portfolio. It's also part of the index. That are the type of companies that we including in our universe. What I think is kind of interesting here is the rate structure. As mentioned, most of the loans are floating, but nevertheless there might be some fixed rates. But here you can see 90% is floating rate, so it's really dominating the floating rate structure. And you can, as I mentioned, there is no duration or almost no duration in the portfolio. And then what I also find kind of interesting is the loan types. Almost 90% of the loans are secured, which I think is one of the most important advantages compared to a traditional bond investment, which is usually not secured. Here you have really a secured loan portfolio. And we should also have the industry sectors here in the loan portfolio. As you can see here, you have a diversified industry breakdown: consumer discretionary, financials, information technology, industrials. And when you look at IT, information technology, you will also see, when you look over the past 10 years, this has increased from roughly 10% to now over 20%. So you see also here the industry breakdown goes with the development in the general market. Interestingly, when you look at real estate, that's part of the financial, because we follow the GICS classification where real estate falls under financial, but in the overall portfolio, real estate makes up less than 2%. So it's basically almost no real estate exposure here, which I also think is another advantage of this investment possibility into private credit. So that's in short what I wanted to show you. In case there are any questions, please feel free to contact me at any time. If you would like to know more about what we are doing, about our other indices, about our other services, feel free to subscribe to our barometer, where you can find the barcode, the QR code here in the presentation. But again, in case you have any question, in case there is something unclear, or you would like to have access to the presentation, feel free to reach out and contact me. And now I would like to thank you for your participation. And I currently don't see any more questions here. So again, thank you very much, and looking forward to our next webinar.